Well, hello everyone and welcome. My name's Elliot Gu. I'm co-founder and chief strategist of the Energy and Income Advisor service. And I'm here today. I want to talk a little bit about crude oil. Now, last week I sent out a video, that I posted here on YouTube as well, that was about the natural gas market and how I saw 2025 as the year of natural gas. And I still believe that's the case. But I did actually receive a number of questions and comments from readers and listeners to the video, really centered around 2 points. First point was the audio on that video, and I apologize for this, was pretty terrible. And so I apologize for that. It's all my fault. I have this brand new speaker right here, or microphone rather, and I forgot to hook it up before recording the video. So I apologize for the sound. Hopefully this one will be much better. The second thing was, what about oil? I'm bullish on natural gas and particularly bullish on natural gas producers rather than short-term natural gas prices themselves. But the obvious question is, what about oil? And actually, I am quite bullish on oil prices as we move through 2025 as well. And I think the market's really got the oil market wrong, if you will. The supply-demand balance for oil is incorrect. The crowd is wrong about oil. And I think it could be a very good environment for both speculators in the financial futures market or in exchange-traded funds from a trading perspective on oil itself, as well as I think a really big opportunity in some oil-levered names, producers, services stocks, and the like. And today I want to talk a little bit about what I think is actually the most important part of the oil market, and that's the supply side of the equation. And we're going to talk a little bit about that today. I've got a number of slides to show you. But before I jump into that, I wanted to back up for just 1 second and say that over the years, and I've been following the oil market for over 25 years now, believe it or not, and I'm often asked or presented or hear other people talking about all sorts of theories for why oil prices are going up or down. Everything from geopolitics, geopolitical events, wars, and the like, to politics, U.S. politics, such as, of course, the recent U.S. presidential election, as well as things like, one common theme I heard over many years was about the dollar. I'd go on TV a lot, and people would ask, is the reason oil prices are up or down because of moves in the U.S. dollar? And really, all of those factors that I just mentioned, geopolitics, politics, and the US dollar, despite what you may have heard, there really are sideshows for the oil market. The meat of the oil market is really just 3 factors. It's demand, supply, and those 2 factors are balanced by price. And I would argue that right now, and in most major cycles for oil, not short-term swings, but longer-term cycles for oil, supply is the most important factor. It dominates those cycles. So let's jump right into it. This first table that I just threw up on your screen here is actually from the International Energy Agency, the IEA. And for those of you who may be unfamiliar with the IEA, it's a Paris-based organization created by the developed world back in the 1970s, your big industrialized countries back in the 1970s, as sort of a counterpoint to OPEC. But one of the things that IEA does is they put together oil market forecasts. In fact, they have an oil market report that comes out every month. I took this from the supply section of their oil market report that came out in September of last year, which is the latest report for which I have the full data set from them. And what it shows is it shows historic production estimates for various regions of the world. These are all non-OPEC regions, areas outside of OPEC and OPEC plus. And you're looking at oil production, what they call oil production. I'll get to that in a minute. From the United States and Canada combined, from the US itself, from Canada, Latin America as a whole, which is Brazil and Guyana, are the 2 main players there, and I'll get to that in a moment. Then all other non-OPEC plus countries, and then of course the total of all this, total non-OPEC. And again, what I'm showing you is quarterly production estimates for oil in millions of barrels a day, right? For every quarter from Q1 2024 through Q4 of 2025. So some historic and then projections through the end of this year. And on the very right-hand side, you see those two right-hand-most columns. You have the IEA's expectations or forecast for 2025 oil production versus 2025. So a positive number would be growth in oil production this year versus last year. Again, we are in early 2025 here. So, for example, you see for the US and Canada combined, they're forecasting something like 700,000 barrels a day of oil production growth for 2025 as a whole versus 2024 as a whole. In Q4, the fourth quarter of this year versus the fourth quarter of last year, Q4 2024, that growth is about 600,000 barrels a day. And there are differences in terms of rounding here between the different components, the US and Canada region. But you can see that most of that growth is expected to come from the United States. And they're looking for about 630,000 barrels a day of that roughly 700,000 barrels a day of growth in production to come from the United States, and particularly U.S. shale fields like the Permian Basin. Outside of North America, of the U.S. and Canada, we have Latin America is also the other region of non-OPEC that's projected to show a lot of growth, 400,000 barrels a day in 2025 versus 2024. Most of that, actually all of that, is projected to come from just two countries in Latin America that are not in OPEC, and those are Brazil and Guyana, okay, which is in northern Latin America. All other non-OPEC countries, they're projecting total growth for all other non-OPEC countries besides the ones I just mentioned, meaning the US, Canada, Latin America, of about 400,000 barrels a day. So total non-OPEC plus production growth in 2025, they're talking about 1.5 million barrels a day. Now, pull back from this table here just a moment. This is the core of both the consensus view on oil for this year, as well as the most prominent bearish argument out there. And that is that even if OPEC Plus continues to withhold barrels from the global oil market, according to their current plan, right now they extended that through Q1, but there is some thought, and I believe they may well extend that eventually through the end of this year. Even if they continue to restrict production, you have 1.5 million barrels a day of growth coming from non-OPEC countries, which is higher than what the IEA thinks demand growth will be for this year. Therefore, the oil market will loosen regardless. There will be a glut of oil on the global market because growth from non-OPEC countries will exceed demand growth, which means that even if OPEC maintains its current production rate, restricted production rate, that'll put downward pressure on oil. Excess supply, building inventories, and the like. Now, there are a few major problems with this view in my view and in the research I've conducted on this. And we'll get to some of them. But first up, let's start with the U.S. Now, on that table I just showed you, they were talking about third quarter and fourth quarter 2024 production from the U.S. alone of over 20 million barrels of oil a day. 20.5 million barrels a day in Q4, 20.4 million barrels a day in Q3. Now, those of you who might follow the U.S. Energy Information Administration, or EIA, which is part of the Department of Energy, know that organization has been talking about U.S. oil production in that 13 to 13.5 million barrel a day range. So, why that 7 million barrel a day difference? That's a big difference. Well, the reason is that different organizations don't classify oil the same way. Believe it or not, there's actually a debate on what exactly oil is. The EIA is talking about what you would consider actual crude oil. The IEA numbers include a lot of what are known as natural gas liquids. Natural gas liquids include the two biggest natural gas liquids are ethane, ethane, and propane. Now, these are liquids. They're considered natural gas liquids. They're considered liquid hydrocarbon. However, they're not the same thing as oil. Ethane is primarily used to produce ethylene, which is a base chemical for make plastics. And then oftentimes, if ethane prices are too low, they actually, the ethane that's produced from natural gas wells in the US, for example, is just left in the natural gas stream to be burned alongside methane, which is natural gas. So ethane, really, you can't exactly take ethane, mix it with crude oil and a US refinery, and produce gasoline, diesel fuel, jet fuel, etc. So it's not the same thing as oil. Same is true of propane, which is used to produce propylene, another base chemical for plastics like PVC, for example. And it is a liquid. It is a natural gas liquid. It's considered a liquid hydrocarbon. However, it's not. You can't just mix it with raw crude oil and have a one-for-one volumetric increase in terms of the volume of crude oil that refinery is processing. There are some natural gas liquids like natural gasoline, which are longer chains of hydrocarbons that can be blended with regular crude oil or into gasoline supply to sort of increase the supply of liquid hydrocarbons like gasoline, diesel, etc. But that's only a very small part of the total natural gas liquid stream out there. That's 7 million barrels a day. Something like 2/3 of it is propane and ethane alone. A lot of the rest is butane and isobutane and other hydrocarbons that cannot be used as a direct additive to oil. They're not the same thing as oil. So there is a discrepancy there, which I'll talk a little bit more about here in a moment and why that's important. But if we look at just oil as the EIA defines it, the U.S. Energy Information Administration, here's the picture. And this slide that I just put up on your screen actually shows U.S. monthly oil production. This is actual oil production defined by the EIA all the way back to January of 2000. This is a monthly number. In this estimate, I've also added in the EIA's adjustment factor, supply adjustment factor. Now, the supply adjustment factor, I won't go too far in the weeds on this because they'll probably click away from this video if I did. But basically, it's an error term, a fudge factor, if you will. The EIA adds to their monthly petroleum reports to balance their estimates of supply, demand, and changes in inventory, storage levels. So if the numbers don't quite sum up such that supply, right, and demand balance, they add this supply adjustment factor in to make the numbers balance. And they changed their oil production estimation methodology back last summer, in the summer, rather 2 summers ago, in the summer of 2023. So numbers released since that time are not directly comparable with numbers released farther back in the past, say in 2022 or 2021. So what I've done is I've added that adjustment factor to their oil production estimate to make the numbers all comparable. So we're comparing basically oranges to oranges instead of apples to oranges. And what you can see here on this chart is that from January 2000 up until about 2005, 2006, U.S. oil production was generally declining. A lot of people have talked about, U.S. oil production was in a state of terminal decline. Then we saw the shale revolution. So we jumped from lows, under 5 million barrels a day at one point, to by 2014, we were up close to 10 million barrels a day. And at the peak, we were up around 13.8, 13.9 million barrels a day of U.S. oil production. That peak was in 2020, in early 2020. But look at how oil production has evolved since that time. And what I can tell you is that since 2020, U.S. oil production is actually down, not up. Down, not up. And I know there's a lot of people out there who seem to be implying that, U.S. oil production has never been higher. It's at new record highs. It's booming, but it's not. 5 years ago, in early 2020, just before the coronavirus outbreak, just before COVID-related lockdowns, U.S. oil production was actually higher than it is today. Now, looking at the more recent data, which I've kind of circled here on the chart for you, from December 2023 up until the present, which for this would be October 2024, the latest numbers we have from EIA, U.S. oil production is down since December 2023, and since the middle of 2023, so a year and a half ago, right? Oil production is up less than 90,000 barrels a day, which is nothing in the context of a U.S. oil market where consumption tops 20 million barrels a day and production tops 13 million barrels a day. So U.S. oil production just isn't growing. So why exactly is IEA estimating growth from the U.S. alone out of that 1.5 million barrels a day of non-OPEC production? They're projecting most of that to come from North America, 700,000 barrels a day, and most of that, 630,000 barrels a day, to come from the United States alone, whereas United States oil production is, at best, flat. What's going to make it go up? Well, I'll tell you, the only force in nature which can really encourage more production from the U.S. is higher oil prices. But take a look at this chart. This is a longer-term chart of WTI, West Texas Intermediate crude oil. I took this back several years, so you can see back to 2020. So you can see that collapse in prices back in early 2020 amid the coronavirus lockdowns. The big recovery to a peak in 2022, well over $100 a barrel. And since then, we slid into this basically wide trading range. The lows of that trading range are down in, say, the mid-60s. That's the lower sort of blue boxed area, support zone on the chart, if you will, that I put on this chart. And then the peak for oil has generally been up around the high 80s to mid 90s range, which I've also boxed on this chart. So oil has been basically in a trading range, and right now in the low 70s, we're much closer to the bottom end of that trading range than we are to the top end of that trading range. Now, just very recently, late last week, oil prices did break out to the highest levels we've seen in about 3 months. And my view is that we will see $90 a barrel for WTI at some point in the first half of 2025. The only thing that I can see derailing that would be a U.S. recession, which I don't think is likely, at least in the first half of this year. Why do we think that U.S. oil companies would produce more oil with oil near the lowest levels it's been in the past few years, since we came off those 2022 highs? So it's really been all of 2023, all of 2024, we're at the low end of that trading range. The reality is that U.S. shale oil production is, and U.S. oil production is actually declining as well. So the EIA is forecasting a return to growth rates, a growth in U.S. oil production that we haven't seen in years, since the peak of the shale boom or since the pre-2019-2020 era. So U.S. shale oil production is a function of capital spending. So capital spending is the money that a producer pays to drill and complete, fracture, and to put into production new oil wells, right? If they're an oil producer, or gas wells if they're a gas producer. And the capital spending decision is very simple. Companies make this decision based on the free cash flow they can generate. Now, obviously, if prices are $90 a barrel for oil and they're primarily an oil producer, and I'll talk a little bit more about that in a moment, then they're going to be willing to spend more capital to drill and complete more wells to take advantage of those higher commodity prices, those higher prices for oil, because they can generate more free cash flow and make more money. They'll also want to spend capital so they can actually grow their production. When oil prices are relatively low, as they are today, near the low end of that trading range, companies are looking for ways to preserve capital, cut capital spending, and they're willing to allow their production to flatline or even decline, because, why produce more oil into a market that looks a little oversupplied, or people are worried about being oversupplied, and prices are anyway relatively low? Why produce more oil? Why grow your oil production 10% into a $73 market when you could maybe just keep that oil in the ground for another 6 or 12 months, save capital in the process, and then grow your production into a, say, $80 or $90 a barrel oil market? You wouldn't, is the answer to that question. Let me throw up this slide for you. This is a slide, I think some of you may have seen this one before, but it's actually based on the Q3 numbers from Diamondback Energy, which trades under the symbol FANG, F-A-N-G, like snake fangs. And this company is a mixed producer. They produce oil, natural gas and natural gas liquids, primarily oil. More than half their production is oil from the Permian Basin of Texas and New Mexico. They're one of the most efficient companies in the United States in terms of their cost structure. And what I've done here on this slide is I've actually calculated their costs per barrel. And what you can see here is that their total costs per barrel of oil equivalent production is $26.21 per barrel of oil equivalent. The actual amount they generated per barrel of oil equivalent production in Q3 was $45.43. So they produced over $1 billion in free cash flow in Q3 alone. So their cost structure, of their $26.21 in total costs, $13.09 of that is actually capital spending per barrel of oil equivalent production. So, so Diamondback can actually produce positive free cash flow even with oil prices, way down in the 40s, right, where their total cost, all-in cost of the value of their barrel of oil equivalent is way down in the 20s or low 30s. But they haven't been growing production much on an organic basis, only via acquisitions here and there. But they're not growing their production at $73. So why do you think that they would produce more oil if oil prices were to slide below the lows of that trading range? I don't think they would. I think they would look to cut down that $13.09 a barrel of oil equivalent of capital spending, allow their production to slide and hold on to or preserve cash flow. They would cut costs in a falling oil price environment rather than even maintaining capital at the current level. They're certainly not going to increase capital spending at lower oil prices and allow their free cash flow to fall off a cliff. It really is dollars and cents. The other aspect that I think is widely overlooked in the global oil market and in this, what I like to call the Phantom Glut bearish argument, is that, companies like FANG, like Diamondback, can grow their oil production easily. And that's simply not the case. And let me throw up another slide for you here. What I've done here is I've looked at FANG's production broken down by commodity in Q3 2022, Q3 2023, and their most recent reported quarter, which was Q3 2024. They won't report Q4 2024 for another few weeks here. And what you can see is that in the third quarter of 2022, 57.4% of every barrel of oil equivalent coming out of the ground for Diamondback was crude oil. 21.2% was natural gas, and 21.33% was natural gas liquids like ethane, propane, butane, isobutane. By the third quarter of 2024, the most recent reported quarter, their oil production had dropped to 56.2% of that barrel of oil equivalent. So their amount of oil they're producing as a percentage of every barrel they produce out of the ground is actually shrinking. Natural gas is about flat at 21.1%, but natural gas liquids production, which as I explained earlier, isn't the same thing as oil, is actually growing at a much faster pace for Diamondback. And the other point to note is that Diamondback is actually one of the more efficient, capital efficient, and oilier producers out there in the Permian Basin. Let's take a look at another name, Devon Energy. And what I'm looking at here, what you're looking at here, is their production mix in barrels of oil equivalent per day for every quarter going back to the third quarter of 2021. So I'm taking this back even further in the past. The blue part of each column is actual oil production. The orange part is natural gas production, and the green part is, again, those natural gas liquids commodities production. And maybe you can't see it particularly easily on this slide, but even though Devon is primarily considered an oil producer, less than half their production is actually crude oil. In the third quarter of 2021, oil comprised about 49.8% of Devon's total output. And that compares to just over 46% today. And this is over a period of just 3 years. Over the same time period, natural gas liquids have grown from 24.3% of their total output all the way up to 26.7% of their total output. While natural gas is up to 27.3% of Devon's production from 25.8% in 2020 in the third quarter of 2021. Now, by convention, 1 barrel of liquids, whether it's crude oil or a mixed barrel of natural gas liquids, equals a barrel of oil equivalent production. That's by convention in the energy industry. Energy equivalence, it's called. Meanwhile, since there are about 6 million British thermal units of energy in a barrel of oil and 1 million BTUs in 1,000 cubic feet of natural gas volumes, natural gas volumes, methane production volumes are converted into barrels of oil equivalent using a 6,000 cubic feet of gas equals 1 barrel of oil equivalent oil production. But those energy equivalence calculations, standards, conventions, don't reflect the reality of oil, gas, and natural gas liquids pricing. Let me explain. In third quarter of 2024, Devon sold its oil production at $73.74 a barrel, including hedges, while natural gas liquids brought them just $19.25 a barrel. A barrel of oil equivalent, or a barrel of NGLs, only got them $19.25 versus over almost $74 a barrel for oil. So a barrel of natural gas liquids was worth 26% of a barrel of oil in the third quarter of 2024. Meanwhile, 1,000 cubic feet of gas in Q3 2024, Devon sold that for 84 cents, including the benefit of hedges. 84 cents, 1,000 cubic feet. That means that 1 barrel of oil equivalent gas production brought them only about $5.04 per barrel of oil equivalent of gas production. So that's less than 7% of the value of a barrel of oil. So even though the equivalence might mean that gas production growth looks impressive, Devon's gas production growth has been very impressive. It doesn't mean that they're growing their revenues at that pace, and it doesn't mean that they're growing oil production at the same rate as barrels of equivalent oil production. A lot of that growth hasn't been oil, it's been natural gas liquids and natural gas itself. So think about this from a purely mathematical perspective for just a moment here. If the price of natural gas and natural gas liquids is low or falling, then a company like Devon, which is seeing the proportion, the mix of their production move more in favor of natural gas and natural gas liquids and away from oil in percentage terms, they're gonna need one of two things. If they want to grow production, they're going to have to drill even more aggressively, spend more capital spending, because the growth in their oil production will lag behind the growth in their natural gas and natural gas liquids production. The second thing is that to generate the same level of free cash flow, when you produce a barrel of oil equivalent that's, say, 56% oil versus, say, 45% oil, you're going to need higher oil prices to offset those depressed natural gas and natural gas liquids prices over time. So the bottom line, in my view, is that IEA's oil production forecast, growth forecast of 630,000 barrels a day here in the U.S. or 1.5 million barrels a day outside the U.S., non-OPEC overall, including the U.S. and Canada, it looks like pure fantasy to me. It's not based in the reality of actual U.S. oil production. And I just showed you it's not based on the reality, the economics for the big shale producers, whether that's a name like Diamondback, a name like Devon, or in fact a name like ExxonMobil or Chevron. Now, of course, the United States is not the only source of non-OPEC oil production in the world, and certainly not the only source of non-OPEC production growth expected by IEA in 2025. I do think that their estimates for growth out of Guyana makes a lot of sense. ExxonMobil is developing a major project there in stages, and as they bring more stages online, production will rise. Brazil, I think they have a legitimate shot at Brazilian production growing over time. Their exact number, Brazilian production has lately disappointed expectations, but they could be right there. But what really gets me is not only their U.S. numbers being just whacked, but their non-OPEC excluding those 4 countries I mentioned: Canada, the United States, Guyana, and Brazil. Outside that, they're projecting 400,000 barrels a day of oil production growth, when the reality of the situation is that most of those countries have actually been seeing declining production in recent years. Check out this chart. This chart's from the BP statistical, or rather it's now the Energy Institute, statistical review of global energy, of world energy. And this is total production from all non-OPEC plus countries, excluding the US, Canada, Brazil, and Guyana, from 2000 all the way up to 2023, which is the latest year for which we have data. And you can see that, production from these countries as a whole has been falling, since for more than 15 years now. And over the last few years, it's been at best flat to a slight drift higher, but nothing like 400,000 barrels a day that IEA is projecting for 2025 alone. It just doesn't add up. We haven't seen growth of 400,000 barrels a day for these countries in really any time in the past 20 years, since back in that 2000 to 2003 type of era, when production from some of these countries was growing at a more rapid clip. So in my view, the supply growth estimates from IEA just don't add up. We're beginning to see that in the actual physical data as well. We're seeing U.S. oil inventories are actually draining. They look tight. I think we may see through the first half of 2025, unless there's some sort of a major global recession, global oil inventories continue to draw down, can decline. And at some point in the next few months, I think that it's going to become untenable to continue to pursue this view that there's a global glut of oil on the market, regardless of what OPEC Plus does, when global oil inventories are falling. U.S. oil production is actually declining, and I think will continue to decline into the first half of 2025. In fact, I think that we may see a lot more here in the next 4 or 5 weeks as all these U.S. shale producers report earnings. Names like Diamondback and Devon that I just showed you, and forecast, flat to lower capital spending, very modest at best oil production growth, maybe more growth out of natural gas liquids and natural gas. So the bottom line from all this is that I think we will see higher oil prices in the first half. I think you have to be very careful about the names that you want to buy. You want to buy high quality producer names, companies that can generate positive free cash flow, even if oil prices kind of continue to scrape along or trade sideways. You want to buy companies that can continue to pay dividends, grow their capital distributions, even in low commodity price environments. We like names like EOG Resources, that has proven its ability to produce oil profitably, generate free cash flow at relatively low prices. On the super major side, I like names like ExxonMobil versus most of the other names out there, because they actually are growing their oil production from projects like Guyana, very low cost oil production. So I think you have to pick your places, but I think that we're actually in the early stages of a major change in character for the oil market. And I think we saw that at the end of last week. Oil prices began to break higher. They've been trading in a very tight range for months, and I think you're going to see more upside as we move through the first half of 2025. In some of our trading services, we're actually trading it through ETFs like the U.S. Oil Fund ETF, and in Energy and Income Advisor, we're actually looking at this month in January. We're going to be going through, we do this every quarter, but we're going through all the oil producers out there, looking at their cost structure. We'll be updating that as their releases come out, and identifying those handful of names that are best positioned to take advantage of say $80 to $90 oil prices on average through this year. So I hope you found that useful. I hope that sort of helps explain my thoughts on oil, why I think supply is so important. The reality which I can't believe it's being ignored, that U.S. oil production is actually falling. I think if you'd said that a year ago, a lot of people would have called you crazy, but it's actually happening. And right now, the market is only just beginning, maybe in this last few weeks, to recognize that. So I hope you found that useful. I hope you found some of the charts I showed you interesting. If you'd like to find out more about what we're recommending in Energy and Income Advisor, some of the specific names, see our upcoming reports, in particular on the producer area, we are offering 60-day risk-free trials to Energy and Income Advisor to all new readers for a limited time. If you'd like to take advantage of that, I'll put a link below this video. You can click on it. Again, it's try the service risk-free for 60 days. If you don't like it for any reason, cancel your subscription for a full refund. No questions asked. You can also give us a call on the 1-800 number, which is in the link below, our toll-free number, which is in the link below this video on your screen. Tell Sherry, our customer service manager, that you watched this video with me, Elliot, and she'll make sure you get the discounted rate we're offering for EIA, as well as that extended risk-free trial period. So again, thanks for listening to me again today. Hope you found this interesting, and I hope to welcome some of you as new readers of the Energy and Income Advisor service here in just the next few minutes. Thanks again.